Hey everyone, and welcome back to Money Journey. Look at the market. We are near all-time highs. The S&P 500 is up a staggering amount year to date, following two phenomenal years of 20% plus gains. It's hard to ignore the excitement. Whether it's the AI revolution, cutting-edge technology, or simply market momentum, investors are pouring money into growth. But this excitement often comes at a cost. When everyone is chasing the hot stocks, the boring companies, the solid, established value business in sectors like industrials, healthcare, or consumer defensives can get left behind. Their valuation becomes stretched thin, not on fundamentals but on sheer enthusiasm. And that, my friends, is where we can find opportunity. Today, I'm diving deep to bring you my list of 5 value stocks to buy. These are not speculative bets. These are companies with robust business models, strong competitive advantage, and the financial fundamentals to back them up. I will give you a quick rundown on each company, explain what makes their business compelling, break down their current valuation, and tell you the exact price I will be looking to add them to my portfolio. If you are looking to find true unloved value in this overvalued market, stick around. We are going to want these 5 stocks on your watch list. Let's get started. The first value stock we are talking today will be Otis Worldwide. Otis is the world leader in escalators and elevators. They do the design, manufacture, install, repair, modernization. So they are basically the world leader and the most trusted brand. They are very monopolistic and face low competition. In terms of forward P, a 24 P could be very low, especially because we see some catalysts coming. They are expected to resume growth because their revenue grow less than 2% in the last 5 years, which is very low for a company like Otis. That is basically because a slowdown on China, on new construction on China. So they depend a lot on China as well and the world overall because they are a world leader in escalators and elevators. One thing I like, they are expected to grow earnings per share around 9% in the next 5 years. So a catalyst for this company is resume growth, new constructions, and one thing I really like in this business and their business is their recurring revenues, their maintenance, their revision on the escalator are already, their install base is huge worldwide. So if you have an elevator in your house, on your building, on big buildings, you have to do the maintenance. You cannot risk to not do the maintenance because it could be a lot of problems if an elevator has problems and their maintenance is not done. So it's very dangerous. So that's why I really like that recurring revenue on maintenance. So that is a company that with revenues very recurring, which is very good, and you have to pay a premium for that. In terms of margins, healthy margin for an industrial company, not high margin like tech business, but 30% gross margins, profit margins around 10%. So that's very healthy. They have a very good balance sheet. They could pay all their debt like in 3 or 4 years of their net income, for example. In terms of, they have plenty of pricing power because of their monopolistic position, and if you want to change to another brand, if you have already an elevator, switching costs are huge, so they have plenty of pricing power. It's one advantage on their business and one of the key characters I like Otis. Rates of return 57%. This is huge. Every dollar invested in their business yields high return, so it's something we always want to see in a company. And their moat is wide. They have this monopolistic position and they are one of the best in the world in what they do, so that's very good. And a free cash flow per share has been growing around 5% higher than their revenue growth. So if their revenue reaccelerate, free cash flow per share will grow as well because they do some buybacks as well to increase that free cash flow per share growth. They've been returning, they pay a dividend of around 2%, do 2% buybacks overall. So with a quality score 73.2, which is very, very good. I love this company. It's a very high quality business. In terms of valuation, it's a US company, very safe, diversified revenues, so I'm expecting them to increase margins around 12%, growing revenues around 4%, and I believe they deserve a premium, even though they do not grow a lot in terms of revenue, and they doesn't have the highest margins overall. It is a very monopolistic company, very safe business, and they deserve a big premium. So I'm assuming a 20p, and with this assumption I came with an intrinsic value of 76. I would say a fair value for me will be around 80. It's very difficult to find these companies cheaper. We have seen this under 90. Under 90 it looks very attractive, because it is a very good company and I love that. So I will do more research on this, and I will be looking if this comes down a little bit. Another company is Pool Corp. Pool Corp, they manufacture, have the product, this very big monopolistic company. If you have a pool, you probably have a lot of products coming from this company. Trade doesn't look very cheap. It is one of the Berkshire Hathaway have been buying, especially around $290, as we see now. One thing I like, they've been growing a lot. Their revenues, it was a COVID boom, but we see in their revenues, but they decreased revenue, and now they are resuming growth at a normal pace. I would say like above 5% growth. One thing I like, again, high quality revenue with very recurring business, so very monopolistic company with a lot of pricing power. Margin the same with Otis, industrial margin not high but very healthy. In terms of balance sheet, they have better balance sheet. They basically have almost no debt. They could pay that in less than 1 year of free cash flow. Rates of return really high, almost 28%, which is very, very good. So every dollar invested in this business yielding high returns. They have a very big moat, wide moat, because of their brand. Free cash flow per share has been growing 25% per year, which is incredible. And they've been returning capital to the shareholder. They've been doing buybacks and paying a dividend. And with that, Pool Corp is one of the most monopolistic companies in the industrial space. They basically have no competition, so I came with a quality score of 80. In terms of valuation, very safe company to invest. I'm expecting them to have free cash flow margin around 10%, growing at the rate of revenues growing at 4%. So a PE, conservative PE, but they deserve a premium of around 20, which is a 5% yield. And with that, I came with an intrinsic value of $250. We have seen Berkshire Hathaway buying Pool under 300. I would prefer. I think this is a very good price to start a position in Pool, around $290. I have to do more research, but it's a price that is starting to getting very interesting. Then we have Procter and Gamble, which is a very defensive company. What I like, you basically, if you in your house, you probably have plenty of product that comes from Procter and Gamble, household products, and it is a recession-proof stock. So their revenues grow year over year. You see in this graph, it's something beautiful to see. Revenues growing each and every year. With that, their profitability as well. So in terms of business, one of my favorite companies. Usually they are very stable, recession-proof, very recurring revenues as well. So their shares outstanding going down, returns on invested capital very high. So it is a very safe asset to own. As I say, high quality revenues. Gross margin of 50%, profit margin almost 20%, which is this is high margin business in terms of industrials and defensive companies. They have a lot of pricing power. They have better margin than their competition. They basically have no debt as well. High returns on invested capital, almost 20%. High moat as well, because their brand is well known worldwide, not only on the US but all over the world. They've been growing steadily, very boring business, but it's growing every single year, recession proof, and it's like a very safe asset to own, especially if you believe the market is overstretched. So they've been returning capital as well. In terms of valuation, one of the safest companies out there. I'm expecting them to have free cash flow margin around 20%, growing around 4%. each and every year. So I think they deserve 20p at the best. So with that, my fair value would be around $132. So it's getting closer, still 10-15% above my fair value, but it's very difficult. I'll get interested if this company drops a little bit, like $145. I will continue to do my research. It's on my watch list, and one of the companies I'm interested in buying at this environment for sure. Another value stock that you should add to your watch list is Unilever. It's like Procter & Gamble, household product, very defensive company, recession proof. Unilever has been growing nowhere in the last 10 years, 5 years. They've been growing revenues around 2% or less than that, but they're expecting earnings per share growth of around 7.5%. So we could see their growth increasing, so that's a good catalyst to own. And if you believe the market is overstretched or it could come a recession, Unilever will be a very safe asset in this environment. So I like that. Very defensive company, recurring revenues, because you will have to buy your household products each month, each year, whatever the recurring is, but it will be a very safe. You will not buy like your cleaning products because you are facing difficulty. Yeah, you have to clean your house, you have to use Unilever product, Procter & Gamble products, even though you are facing some difficulties. High gross margins above 40%. They've been maintaining their margins, and they have better margins than competition. So, and with the brands they own, they have plenty of pricing power. That's something I like to see. The net income per share, free cash flow per share, very steady but growing at a really slow pace. But it's, like I said, a very boring company. Returns on invested capital going down, but still holding above 30%, which is very high. And shares outstanding going down. This is a good sign from management that they believe the shares or Unilever stock is undervalued. So they have their brand moat, they have their network effect. This is a very big company which is trusted by their clients, and they've been returning capital to the shareholder. Right now they pay a dividend of 3%, which is very healthy, and with that, add to that some buybacks. They bought around 1% just this year, so they could be buying back 1 to 2%. So it comes like a shareholder yield around 5%, which is very good. So in terms of valuation, UK company is safe, a very safe company. I'm expecting them to have margins, free cash flow margin around 12%, growth of 4%, and I think they deserve a premium like the other companies, like a 20p. Maybe Procter & Gamble deserves a better one because they have better margin, better product, better brands, and they have a historical track record better than Unilever. So maybe the Procter & Gamble deserves a better P. But with Unilever, I came with an intrinsic value around 57. Right now, trading at $63. Unilever was below my fair price a year ago, some months ago. I would be very interesting to take another look if this company drops more 5 to 10%. So it is a very good company to have in my watch list. Another company very good is McCormick. The seasonal, they sell seasonal spices. So very boring company, consumer defensive company. So I like their business and their fundamentals. Revenues growing very steadily, which for me it looks like a very safe asset, even probably recession proof. You have to season and to use your season on your cooking. So and they've been growing very good each and every year. What I like in this company, it's a very defensive company, consumer base, growing steadily around 4 to 5%, very good margin, better than the competition. And they have plenty of pricing power because of their brand. If you have to decide to buy a McCormick's spicy or another brand, you'll buy McCormick because their brand is very trusted by clients. Returns on invested capital or in equity, almost 20%, which is very good. That management has a really great track record, is doing an incredible job, and they've been growing free cash flow per share around 40%. So they have a wide moat, and they've been returning capital to the shareholders. So all attributes that I like to see in this company. McCormick, it's incredible. It's an incredible business model. But what is the best price to pay for this company? Let's do valuation. US company, very safe company, so they deserve a lower discount rate because it is an investment or an asset one that has lower risk. 12% free cash flow margin I'm expecting them to have in 7 years. Growth rate around 5% revenues, and a PE around 20. I think they deserve it, a premium like that. All the companies we have talked today are very monopolistic companies, very good business with wide moats. So a 5% yield, I think it's fair. And with that, I came in intrinsic value of $57 right now. McCormick is trading at 67, slightly 15 to 20% above my fair value. I think if the company drops 10% more, around $60, it could be a very good price to start the position. And since I love these companies and all the 5 companies I've talked today, so this is my entry points. All good companies, very recession-proof stocks, especially that are very good assets to own at this environment right now. So there you have it. 5 high-quality value stocks that I believe offer a compelling risk-reward proposition in today's environment. The main takeaway here is simple. While the broader market continues to soar, fueled largely by growth and tech, incredible opportunities are created in sectors and companies that the market is currently ignoring. We are focused on finding that margin of safety, investing in fundamentally sound business when their price is below their intrinsic value. These are companies that will allow you to sleep well at night, knowing you bought quality at a discount. Now, I want to hear from you. Which of these 5 stocks are you most interested in? Are there any other value plays you are researching right now? Let me know in the comments below. And if this video helped you find a single new idea for your investment research, please hit that like button and most importantly, subscribe to the channel. We break down fundamentals, valuation and market opportunities every week. Hit the bell notification so you don't miss the next deep dive. Thanks for watching and I'll see you in the next video. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.